Close your eyes for a second and imagine this. A market that should be dead, companies that should be gone, losses that should have cleared, and yet everything is still standing, not because it's healthy, not because it's profitable, but because someone, somewhere, keeps the machines humming. This is the $2 trillion zombie market. And the most important thing about it isn't that it exists, it's that they can't let it crash. Here's why that matters right now. If markets worked the way the textbooks say they do, bad companies would fail, capital would move on, pain would be sharp, short, and cleansing. But that's not the market we built. We built a market where failure is postponed, rolled over, repackaged, quietly financed one more time. The result is a strange economy where growth looks real but feels hollow, where jobs exist but productivity doesn't move, where stocks rise but profits don't follow. And it's not an accident, it's a design choice. Let's start small. Picture a company that can't pay its bills unless interest rates stay low. It earns just enough to cover payroll and rent, but not enough to reduce debt. In a normal world, lenders would pull the plug. In this world, they extend the loan, or they refinance it, or they sell it to someone else who's desperate for yield. That company doesn't grow, it doesn't innovate, it doesn't die, it just lingers. Multiply that by thousands. Now scale it up. After the last financial crisis, central banks did something unprecedented. They pushed rates to zero and promised to keep them there. Cheap money wasn't a temporary bridge, it became the foundation. Businesses adapted to it, investors adapted to it, governments adapted to it. Debt stopped being a warning sign and became a strategy. If you can borrow at 3% while inflation runs at 4%, debt isn't a burden, it's a gift. And when rates rise, the math breaks instantly. That's where the zombies come in. A zombie company isn't defined by how old it is or how unpopular its product is. It's defined by math. Specifically, it can't generate enough profit to cover its interest payments without new borrowing. In other words, it survives by refinancing itself. For years, this was easy. Banks made the loans, bond markets bought the paper, investors chased yield wherever it appeared. Nobody asked too many questions because nothing seemed to break. Then rates rose. Suddenly, debt got expensive, refinancing became painful, and the natural expectation was simple. Defaults would spike, weak firms would fail, markets would reset. That didn't happen. Instead, something quieter took over. Loans didn't disappear, they moved. From banks to private credit funds, from public markets to opaque ones, from balance sheets you can see to structures you can't. This is where the zombie market gets its size. Private credit exploded because it promised something seductive: stable returns without the volatility of public markets. Pension funds loved it, insurance companies loved it, endowments loved it. These institutions need yield, but they hate drama. Private lenders stepped in and said, "We can handle this." They lend to companies that banks no longer want. They charge higher rates, they add covenants, they extend maturities, and most importantly, they avoid marking losses in real time. As long as the borrower keeps paying interest, the loan looks fine, even if the principal is never coming back. This is how you get a market that looks calm while pressure builds underneath it. And the number keeps growing. By conservative estimates, trillions of dollars are now tied up in companies that would struggle to survive without constant refinancing. This isn't one sector, it's retail, it's healthcare, it's real estate, it's software firms with shrinking margins, and industrial firms with aging assets. They're not failing fast enough to be visible, they're failing slowly enough to be ignored. Here's the uncomfortable mechanism that keeps it all together. When a zombie company faces trouble, lenders have two choices: force a default and recognize a loss, or extend the loan and pretend time will fix it. Losses hurt balance sheets. Losses trigger redemptions. Losses invite scrutiny. Extensions buy silence, so the system chooses silence. Now zoom out. These loans don't sit in isolation. They're bundled, traded, sliced into funds that promise steady income. Those funds sit inside pensions that support retirees, inside insurance portfolios that back policies, inside endowments that fund universities. A default isn't just a company failing, it's a ripple. That's why they won't let it crash. A mass reset would mean admitting that years of capital were misallocated, that returns were overstated, that risk was underpriced, that stability was an illusion. It would mean writing down assets that entire institutions depend on. So instead, the system stretches. Maturities are extended, terms are renegotiated, interest is capitalized instead of paid. On paper, everything survives. In reality, the economy gets heavier. Zombie companies don't invest aggressively. They don't raise wages. They don't take risks. They just defend their existence. That drags down productivity for everyone else. Healthy firms compete with unhealthy ones that shouldn't exist. Prices stay low, margins get squeezed, innovation slows. This is the irony. The policy tools designed to stabilize the economy end up freezing it. Now compare the story you're told with the one underneath. The hype says markets are resilient, employment is strong, corporate balance sheets are fine. The reality is more fragile. Many companies look solvent only because refinancing remains possible. The moment credit tightens meaningfully, the floor disappears. That's why every sign of stress triggers intervention. A wobble in bonds, liquidity support. A banking scare, emergency facilities. A credit crunch, reassuring words and quiet backstops. None of this is about saving bad companies. It's about protecting the plumbing. Because once defaults cascade, they don't stop neatly. They jump channels. From private credit to public markets. From firms to funds, from funds to institutions that can't afford to explain losses. So the system chooses delay over correction. But delay has a cost. Capital trapped in zombies can't flow to productive uses. Younger firms struggle to get funding. Risk-taking shifts from innovation to financial engineering. And the longer this goes on, the larger the eventual adjustment becomes. This is where the tension sits. Let it crash, and you get pain now. Unemployment rises, asset prices fall, political consequences follow. Don't let it crash, and you get stagnation, slower growth, lower dynamism, a creeping sense that the economy is moving, but not going anywhere. Neither option is clean, but one is visible, the other is slow enough to deny. So the choice is made again and again. Extend, refinance, smooth, hope. Hope that growth returns before the math breaks. Hope inflation erodes the debt quietly. Hope no one pulls the thread too hard. This is why the zombie market isn't a glitch, it's a pressure valve. It absorbs failure so the surface stays calm. And as long as that calm holds, the incentives don't change. But here's the question that never gets answered. What happens when the cost of keeping things alive exceeds the cost of letting them die? Because at some point, refinancing stops being a bridge and becomes a trap. At some point, pretending losses aren't real makes them larger. The system can delay recognition. It can spread pain. It can hide fragility. What it can't do forever is turn weak cash flows into real growth. So the market keeps walking, not alive, not dead, just upright enough to avoid the fall. And the longer it stays that way, the harder the landing becomes. The only unanswered question is whether the crash comes from a sudden shock or from the quiet moment when nobody is willing to refinance one more time.